What's up, everyone? Welcome to the daily macro update for Wednesday, November 12th. My name is Johnny Zerti. Welcome to Macro Optics. Nothing too much in the markets today in terms of news. A little bit of some craziness happening right now with the government shutdown, which we can get into a little bit on that, but there's really nothing to say other than, we'll see what happens when we get inflation tomorrow. Hopefully we get that report, because we've been almost 2 months now without an inflation report. We've been getting signals from the bond market, which is really what we like to pay attention to anyways. So it's not a huge deal, but I was talking with somebody and they were like, how do you use, inflation data? Because I don't really use that too much because it's so lagging. And the point of the CPI reports isn't to be surprised or think anything's differently, because the price markets, looking at the charts, will tell you what inflation is going to do, right? But the thing is that when you start to see the hard data reinforce what you're seeing on the price charts, that's where you can either get a confirmation, and that is what we see in the markets, if it's correct in pricing in inflation, or if it's wrong, or you get the hard data and it's something that's different. So that's really why we use hard data, is to see if it's being confirmed or denied in the markets. But taking a look at the S&P 500 today, it did bounce to the top end of the trading range here. And it's simply just having a rejection from the top end of the trading range. And, the volume has not been too great this week. We've seen a volume drop off, which typically when you see prices rise on lower volume, that's a bearish divergence. See what I'm talking about right here? If I zoom in, see how volume is going up, prices are going up and volume is going down. That's a divergence. So typically when you see a divergence like that, it's a good time to sell some, because if we see volume come back, what's that going to look like? Now, the title of this video is, should you stay in cash? Because that's one of the biggest things that I've been noticing on a lot of the different calls that I get on, as well as, some people sending me direct messages, because there's a lot of uncertainty out there. And so a lot of people are saying, hey, if I just park my cash in a money market fund that's, collecting 4% or whatever, can't I just, weigh this out and just wait for a market crash? Theoretically, yes, if you have a crystal ball and when the market crash is going to happen, but nobody knows when the market crash is going to happen. So over the past 3 years, a lot of people have had that same mindset, and they've missed out on back-to-back 20% gains in the S&P 500. So the whole thing is you don't just want to sit on the sidelines in cash, because ultimately, even if you're in a money market fund, you're going to be losing to inflation, because inflation is a lot higher for things that you specifically pay for, right? What do I mean by that? For example, with food, this is a pretty cool, this is an advertisement, but this is an interesting website here called in2013dollars.com. And you can take a look at different types of CPI categories to see which type of inflation is occurring right now. And so heading over to this this calculator here, let's just take a look at the cumulative inflation in food specifically since 2020, right? So let's just do $100 just to round it up. Okay, so since 2020, $100 back then is the same purchasing power as $126.61 in 2025. Meaning, hold on one second, actually. I think my, hold on one second. Let me pause the live stream. I think my cat is getting into something real quick. Just one second. Look at this guy. Remy, what do you have to say to the people? Don't get into stuff when I'm on the live stream. Say you're sorry. All right. He's an interesting cat. He gets into stuff. He's had 4 stomach surgeries for ingesting foreign objects. I think he has that disease called pica or pica, however it's described. But yeah, that cat's only 2 years old and has had 4 abdomen surgeries. He gets into stuff. He gets into stuff, and we've been trying to put away all the rubber and the plastic in the house, but somehow he ends up finding something. And everything in this day and age is made out of plastic and made out of rubber, so it's pretty hard to manage that. So we're a little bit paranoid whenever we hear him getting into things. So appreciate your patience on the pause there. But getting back into this, taking a look at the CPI for food specifically from 2020 to 2025, we can see that cumulatively, food inflation is up 26.61%, which means in the past 5 years, if you haven't increased your total net worth by 26.61%, that means that you are losing to the silent tax of inflation. And that doesn't even consider actual taxes. You have to understand that your money, half of it's being taken away. So you have actual taxes taking your money away, and then you have the silent tax. And so ultimately, in order to keep up with the rising costs of everything, as well as taxes being as high as they are, you have to make more than just having your cash sit in a money market fund. And if you are not investing it wisely, then you are losing money. And so for the people who say, why can't I just leave my cash in a money market fund? That's the whole reason why. You get taxed when you pay for something. You get taxed when you make money. You get taxed when you transfer money. You get taxed for saving money. The only thing you don't get taxed on is pulling out a loan, but you're still paying interest on that. So that's kind of like being taxed. That's why they don't tax loans, because you're paying interest. And then 2, you have inflation happening cumulatively at 26% for food, and you expect that a 4% money market fund is going to help you keep up with that? Absolutely not. So that's why you have to understand what public markets are doing, and you have to understand that even if you don't have that big of a pile of money to invest, if you're not at least compounding and putting a little bit aside into the markets, and then learning the macro environment in order to make sure that whenever it does go down, that you're not facing huge drawdowns, then you're just simply not competing with the cost of things. So in this day and age, there's no excuse to not learn how to manage your money and how to invest it wisely. So stop doom scrolling, get in a program, watch YouTube videos, make it a goal for yourself this next year to learn how to invest strategically so that you can keep up your purchasing power with the insane central powers that are destroying your purchasing power. All right, let me see here. Let me go back to the charts. Why is this? I'm having some technical difficulties today with the stream, so apologies about that. All right, let's see here. Here we go. Still a little bit laggy, but it'll work. All right. And so let's just go over a couple things here. Let me exit out of these tabs that are making my computer just lag like crazy. I hate these websites that have just like a ton of advertisements on it because it makes the computer go slow. All right. So the other thing to cover today is the government shutdown that supposedly they're going to be voting on later on tonight at around 7 p.m. in order to end the shutdown. Right now, it's been going on day 42, the longest shutdown in U.S. government history. And the press secretary, Caroline Leavitt, went on TV saying that the Democrats may have permanently damaged the federal statistical system with October CPI and jobs reports likely never being released. I think they're getting ahead of something right now because they might be getting those numbers early, seeing that inflation is actually going higher, while at the same time, the jobs market is imploding because that's what the private market is saying. And then when it comes to inflation, when we take a look at the bond market here, specifically the 5-year break-even inflation rate, which if you're not tracking this right now, I don't know what you're doing. But the 5-year break-evens are at the same level that they've been at for the past year. There has been zero progress on inflation since really, let's see here, since November of 2024. So if inflation is remaining sticky, if the jobs market is getting worse, this is the absolute worst environment to be in if you're just a consumer trying to get by. Because your ability to make money isn't even keeping up with how inflation is accelerating still. And, it goes back to that one Truth Social post that Trump posted the other day saying nearly zero inflation. What he's talking about is the change in the rate of change of inflation, right? So you can see here that the 5-year break-even inflation rate has remained relatively flat. That's what he's talking about. This hasn't gone higher, really. But that doesn't mean that that's great news because inflation is still high. It'd be like saying if you got pulled over by a police officer because you were going 100 miles an hour in a 40-mile-an-hour zone, and when the policeman pulls you over, he says, "Sir, do you know you were going 100 miles an hour in a 40 right there?" And then you turn to the cop and say, "Yeah, but hey, I wasn't going 120, right?" The cop's still going to give you a ticket. And so just because the rate of acceleration in the annual price increases are remaining high doesn't mean that, it's still good. Yeah, officer, I was maintaining that 100 miles an hour, so it's okay, right? No, you're still going to get the ticket. Oh, man. So, yeah, that's why gold has been performing way better over the past week or so, is because we're starting to get more data that we're heading into that stagflationary environment yet again. Look at the price of silver. It's back up near to all-time highs. Look at the price of silver miners. They're accelerating. Look at the price of gold. And so not only is this because we're in a stagflationary environment, but you have to remember that the government is completely addicted to printing money on the short end of the curve, meaning that they are just flooding the market right now with treasury bills in order to fund the government. And that's why the deficits still remain incredibly high. And, there really hasn't been any change in the deficit since the Biden years. If we take a look at the deficit tracker, we can see that it's pretty much maintained similar levels that we've seen in the Biden years, which, I don't know about you, but I was hoping that this current government would be able to get a little bit better control over the deficit, and that just is not the case. So if we take a look at this deficit tracker here, and we take a look at the years, so this is the fiscal year beginning in October and ending in September, we can see that for the fiscal year of 2025 in purple here, that for the majority of the time has been above the past 3 years, which, as we know, the Biden administration was blowing out the deficit. That's part of the reason why the market was doing so well. Well, take a look at 2025 here. That has still been, among the highest. And as of right now, it is slightly lower than the 2024, but still way bigger than 2023 and 2022. So the out of control spending is not slowing down at all. It's being maintained. So that's why you have gold doing what it's doing, because it's saying, oh, wow, the government's just going to keep on printing money and flooding the system with treasury bills. Okay. All right, I'll just keep on going up then. So you got gold, base metals, silver, other things like palladium, copper, all having an acceleration due to inflation remaining a problem. You have the government saying, oh, this is all because of the Democrats. This is not looking too good, ladies and gentlemen. And it's just more evidence to point to the fact that we need to be incredibly prudent with our own money and making sure that we are battling these crazy people in Washington. And when I say crazy people, I mean both parties as well as the Federal Reserve System. I'm not just picking on one party. And so, yeah, as unfortunate as it is, we don't really have much power except for voting every 4 years. And so all we can do is keep up with this craziness by investing our money appropriately. Taking a look at what has been performing well over the past week here, we see that silver is the biggest winner so far this week at 5.48%, huge jump. Gold in second place at 2%. Silver has been beating gold for the majority of this year here. Let me scooch over this so I can get my camera well placed. And then taking a look at the sectors here. So the sectors for the week so far have been names that we've already been covering, mainly healthcare being a huge outlier compared to the rest of the 11 sectors of the S&P 500. Nothing even comes close in terms of what's been doing the best. And healthcare is a defensive sector. So when gold as well as healthcare are performing this well, and then also utilities is also doing well, what do you think the trend is right now? There are bull markets happening. It's just not in the traditional ways that you may think. That's why you have to expand your palette of investable assets to more than just AI stocks and cryptocurrencies. That's why macro is so important. And then really just taking a look at the Mag 7 stocks here, pretty much every single one is negative except for Microsoft and Apple. And Microsoft is actually in a bearish trend, so it's just having a little bit of a bear bounce. And so really the only winner here has been Apple so far this week in terms of a bullish trending Mag 7 stock. So yeah, not too well for people who are overweight a lot of the tech sectors. My team and I, we were selling a lot of it at the beginning of the week here as we got that bounce on lower volume, as we pointed out at the beginning of this video. But those are the best and the worst trends so far this week. Taking a look at the yield curve. So this is the United States yield curve here. We can see that over the past month, we've actually been experiencing a bear flattening. A bear flattening is when the 2-year yield, or the short end of the curve, rises more than the long end of the curve, signaling that there is more tightness in the market. And it's not just that we've been seeing that. Obviously, the Fed is seeing this as well, and that's part of the reason why they are ending quantitative tightening. And so we are entering, for the first time post-pandemic, an era of, well, actually, this is the second time because 2022 is the first time that this happened, but we're entering into another era of tighter liquidity. And a lot of people who have, much larger, macro YouTube channels that focus on narratives instead of the actual data like we do here, they're even saying like, hey, after this, that means that quantitative easing is coming next and the Fed is going to start expanding their balance sheet, which is true, but they're going to do that because things are breaking in the markets. And that's typically what happens next. So I do think that this next year is going to most likely have higher than average volatility. That doesn't mean it's bad news. It just means that things that you think are going to work may not work as well as others. We're already seeing that already with gold and healthcare as well as utilities. And so you have to be able to adjust appropriately during these times. This isn't like the time between 2008 and 2020 where interest rates were near zero and all you can do is buy and hold. And, it was relatively easy to make money in the stock market. You would just close your eyes, throw a dart at any type of tech stock, and it would do well. We are not in that environment anymore. With rates being a lot higher on average than they were, 4% is much higher than 0%, as well as with the futures market saying that rates are most likely just going to come down to 3%, the Fed funds rate, and they're not going to go down any lower unless something breaks. So in that type of environment, yeah, you're going to have more liquidity constraints than beforehand. And because of that fact, you're going to have to be more active with your investing style. Now, when I say active, I don't mean day trading. What I mean is that you have to be able to recognize these different macro stages that we're in, and you have to track what's going on to make sure that you are able to stay ahead of the next shift. Now, I would recommend that you find some type of community where they're talking about this. We have ours, as well as our training that we have for people to learn our process. If you guys want to test that out, test the waters there, we do have our 6-week challenge going on right now. Just use the link in the bio to schedule a call with me and we can review the details of that. But if you're not learning and applying macroeconomics to your investing process right now, maybe you're just team technical analysis or just team fundamental analysis. You don't have to be just team one or the other. You have to understand all of them. And as we've seen, fundamentals haven't had as much of an impact as technicals and macro. Valuations, if you were just going off of that over the past 3 years and saying that the market is too expensive, well, you've missed out in 2 years of 20% back to back. Not saying valuation isn't important, it definitely is, but in this new day and age where liquidity is still much higher than it was back, compared to 2019, the trends, the flows, as well as the technicals are being prioritized a little bit more than the fundamentals. And so I would just highly recommend that you find a community that is doing that and prioritizing that. But hey, Remy, don't show your butt on the camera. Okay, people are gonna have to pay extra for that. All right, let's go ahead and get into some questions here, and then we'll go ahead and log off. B Patina S says it's not just inflation, it's also the debase the dollar by printing money. That's the same thing. You're talking just about monetary inflation. So there's two types of inflation. There's monetary inflation, and then there's price inflation. The analogy that I like to use here is that think of inflation like a car. Price inflation is like when you step on the gas to make the car move, and then the gasoline in the tank is monetary inflation. They're two separate things, but they are related, right? You need gas to go, and you can't go anywhere without gas. So usually you have monetary inflation first, where the Fed prints money or debases the currency. And then as a result of that, you have businesses responding to the influx of dollars by then raising the prices of their goods because you have more dollars chasing fewer goods. So there's two types of inflation, monetary as well as price inflation. And then when you get into price inflation, there's different types of price inflation as well. There's cost push, there's demand pull. You can look those up for yourself. It's a simple Google search away. But when people say inflation, when they go on TV, just have to ask yourself, what type of inflation are they referring to? So, yeah, when you have both, price inflation going on right now, as well as monetary inflation, it's too hard to compete. But you are correct in that, the CPI numbers that we see, 3%, that's overall. You have to look at the specific baskets that you typically spend money on, which I don't know about you, but I spend most of my money on housing as well, shelter, as well as food. And so those are the two buckets that I typically pay attention to, and both of them are extremely higher than the average CPI. And then not only are prices increasing, but then you also have your money supply being flooded. So yeah, you're getting both of those happening at the same time. Good comment there. Let's take a look at the comments on Instagram here. Hey Johnny, do you see us heading into an environment where precious metals continue to do well? Yes, I do. They've never broken their bearish trend, by the way, or bullish trend. When we take a look at gold, this has maintained its bullish trend, and it's just had a little bit of a correction over the past month, and now it's regaining trend strength. And this will continue to happen so long as we are in this environment, which is this stop-go phase. And what do I mean by that? When I talk about this stop-go cycle, this is what I'm referring to with this chart above here. And this is that no landing scenario, right? Where we aren't in recession, but we aren't having a thriving economy. And so in this scenario, you have, if we start where it says go, you have where the market is expecting a dovish Fed. Maybe they've guided to that. There's rate cuts being expected. Because of that, stocks rally. There's a soft landing optimism sentiment throughout the market. And because of that, it typically causes higher inflation expectations. Because when you have the Fed being dovish and you're making the monetary environment more easy, that actually causes inflation expectations to rise. And so normally what my team and I do is that we will sell some into that exuberance. And then once the market starts to prioritize the higher inflation expectations, then it goes into the stop phase, where then you have more of a hawkish Fed. Maybe they pause rate cuts. And because of that, stocks drop because they think that, they're just going to get a bunch of rate cuts, and they don't. And then from that, you get hard landing fears. That causes lower inflation expectations, where typically you get a lot of indexes then correcting down to what we call the low end of the trading range. And then as soon as that happens on lower volume, we actually have a good process in order to buy some at that point, where it then goes back into the go phase. And so that's been happening ever since 2023 here, as we can see with this chart. And in this no landing scenario, stocks continue higher. Now, this will continue to happen until we have a hard landing. I'm not sure when that's going to be, and I don't know the magnitude of which that hard landing is going to happen. It could be not a big deal, or it could be catastrophic. Who knows? Only time will tell. But the key thing is to recognize when we are out of this no landing stop-go cycle. And that's what my team and I do for our members in our macro investing community, which again, if you guys are interested in joining that, or at least finding out more on what we're doing, we have our 6-week macro mastery challenge. Just DM me the word master, or just go to the link in my bio to book a time with me and we can chat about it more. But the key is timing on when this changes. And so that's what we're seeing here. And yeah, it's interesting to see how this continues to loop around. Am I clip farming right now? Yes. Let's see if we can get the... Yeah, and just quickly, as of the recording of this video, the target rate probabilities for the Fed meeting, which is in exactly 2 or 4 weeks from now, there's a 65-35 split on cutting rates versus pausing. So when we get this hard data back from the government as it opens up, the key thing is to pay attention to how these probabilities change, because as of right now, the rate of change is that you're getting less of a chance of a cut right now. And so we'll see what happens there moving forward. But yeah, we're seeing more of the stagflationary environment, which in that environment, the Fed is more likely to pause rates. Bitcoin continues to be in bearish trend. We'll see what happens here as volume starts to kick up. And so, yeah, that's what I'm seeing here today. All right, well, let's go ahead and end it there. I appreciate everyone for joining. I know that I didn't get to everyone's questions, so actually, let's just go to 2 more here. I feel like the energy sector is also maintaining a bullish. Yeah, the energy sector is bullish in our model. Can you check SoFi? Yeah, SoFi still remains in a bullish trend. It's testing new all-time highs though, so probably not a great time to chase that. If you're chasing this, that's not what you want to do. All right, we're going to go ahead and wrap it up there. I appreciate everyone for joining, and we will catch you in tomorrow's daily macro update. Bye, everyone.